What if I told you that the man who made $2.69 billion betting against the entire American housing market was not a Wall Street insider, but a night shift doctor? Before Michael Burry became the most feared outsider in finance, he was a neurology resident at Stanford Hospital. A childhood disease took his left eye, and the glass prosthetic taught him early to avoid eye contact, to turn inward, and to build a world of extreme, lonely focus. That focus would one day terrify Wall Street. Because Burry does not invest the way you've been told to invest. He ignores the crowd, ignores the hype, and reads the raw numbers nobody else bothers to read. Today we break down the investment machine inside the mind of the Big Short. Let's get into it. Picture those long hospital nights. While the other doctors grabbed sleep, Burry sat on an online forum called Silicon Investor, dissecting corporate financial statements with a cold, almost surgical eye. And here is the insight that changed everything. Diagnosing a company, he realized, is exactly like diagnosing a patient. You cannot trust the patient's own story, and Wall Street analysts, they're just that story, second-hand. You have to pull up the scans and look for yourself. So what were his X-rays? Two things: free cash flow, spelled FCF, and real asset liquidation value. Forget the glossy narrative, forget the confident CEO on television. Burry wanted to know how much hard cash a business actually generates and what its assets would fetch if everything was sold off tomorrow. That is the skeleton of a company. Everything else is just bedside manner. Fast forward to the year 2000. Burry walked away from medicine entirely and founded Scion Capital with a modest pool of money raised from family and friends. And look at the timing. This was the absolute peak of the dot-com bubble. The market was drunk on tech stocks, paying for dreams instead of earnings. Everyone was chasing the future. Burry ran the opposite direction, straight into the most unfashionable playbook of the last century. Burry's foundation is Benjamin Graham, and he is Graham's most hardcore disciple. His philosophy compresses into one phrase: margin of safety. But he pushes it to the extreme. He does not hunt for the next great company that will change the world. He digs through the market's wreckage for assets that have been brutally mispriced. Many of the stocks he buys trade far below the net current assets sitting on their books. Think about what that means. Even if the company shut its doors and liquidated tomorrow, investors would still walk away with a profit. That is not optimism. That is arithmetic. And to protect that arithmetic, he physically isolates himself from market emotion. No Wall Street cocktail parties. No reliance on so-called market catalysts. His only compass is intrinsic value, derived from discounted cash flow models, DCF for short, which is really just asking one simple question: what is all the future cash of this business worth in today's dollars? If the price on the screen sits absurdly below that number, he buys, even if the company has short-term blemishes. Because cheap fixes a lot of problems. Now here is where the doctor in him takes over. Chapter 2. Stripping off the financial makeup. Burry reviews corporate reports at a forensic level, and he openly despises the metrics most investors worship: earnings per share, EPS, and the price-to-earnings ratio the P/E ratio. Why? Because both are far too easy for management to paint over with accounting maneuvers and stock buybacks. To Burry, those numbers are the patient's self-reported symptoms. Polite, optimistic, and often misleading. His first screening tool is the enterprise value to EBITDA multiple, EV over EBITDA. Here is the everyday translation. Enterprise value is what you would truly pay to own the whole company. Because when you buy a house, you also inherit its mortgage. Enterprise value drags a company's real debt into the sunlight. A stock can look dirt cheap on its P/E ratio, but if the EV check reveals a mountain of hidden debt, Burry throws it straight into the trash. No exceptions. But the lifeblood he truly tracks is free cash flow. In Burry's eyes, profit is just an accounting opinion. Free cash flow is the only truth. The actual cash left over after a business pays to keep itself running, and the single best defense against systemic shocks. And to find it, he does the boring work nobody else will do. Year after year, he buries himself in thousands of SEC 10K filings and prospectuses, documents running hundreds of pages each, hunting for the cash cows the market has completely overlooked. Then came 2005, and the trade that made him a legend. Burry aimed his scalpel at the American housing market. Now understand, this was not some random macro gamble. It was the inevitable output of bottom-up data. While Wall Street was slicing mortgage risk into products nobody questioned, Burry quietly concluded the entire structure was rotten at the foundation. He was one of the only people on the planet who actually read the underlying prospectuses of those collateralized debt obligations, CDOs, the towering bundles packed with thousands of subprime mortgages. Page by page, loan by loan. And by tracking the early default rate data, he reached a conclusion that was mathematically irreversible. The defaults were not a possibility. They were a schedule. The entire system was going to collapse. And this is where his genius truly shows. The core of his philosophy: build an extremely asymmetric risk-reward structure. He did not short the bank stocks directly, because shorting exposes you to unlimited losses. Instead, he persuaded Goldman Sachs and Deutsche Bank to custom-build credit default swaps, CDS contracts, just for him. Think of it as buying fire insurance on your neighbor's house. If housing never collapsed, all he lost was a small annual premium. So his downside was locked and limited. But if it did collapse, the payout was 100 times over. Heads, he loses a little. Tails, he wins a fortune. That limited loss, bottomless upside structure is the highest art of his trading. Now let's zoom out to Chapter 4, The Ruthless Hunter. Forget the Warren Buffett and Philip Fisher school of buying wonderful companies and holding them forever. At his core, Burry is an absolutely rational arbitrageur. He has zero interest in befriending management and zero emotional attachment to any stock. His portfolio holds only about 12 to 18 names at a time, highly concentrated bets. But unlike a classic value investor, his turnover rate is extremely high. Here is his discipline. The moment a deep value stock climbs back to the intrinsic value he calculated, or it rips 40 to 50% higher in a short window, he sells. No hesitation, no second thoughts, no loyalty. The cash immediately rotates into the next undervalued cigar butt or arbitrage setup. And on the way in, he is just as tactical. He often waits until a beaten-down stock has already bounced 10 to 15% off its 52-week low before pulling the trigger, using a whisper of technical confirmation to escort his value judgment. Patience on entry. Ruthlessness on exit. So what does it all add up to? $2.69 billion in profit from the subprime collapse. Years of stark warnings about stock market bubbles posted late at night. And through all of it, the same figure, sitting alone in front of a few monitors, staring down financial data like a pathologist with a scalpel. There is no magic in Michael Burry's philosophy, just brutally boring diligence, absolute faith in free cash flow, and the cold rationality to stand against the entire world armed with nothing but hard data when the crowd goes mad. So here is my question for you. In a market this euphoric, would you have the stomach to be the lonely one in the room? Drop your take in the comments, and if this breakdown sharpened your thinking, subscribe, because the next deep dive is coming.